Good evening friends. Today we're gonna see the technical parameters and how to actually trade the Nifty options with case studies, and also how to actually make consistent profits month on month. Today's topic was how to identify the stop loss. The stop loss is one of the crucial aspects of trading. For every trader, he has to accept some certain amount of loss to gain the certain percentage of profit, because in this world none of the trader is 100% accurate on his prediction. For that, the first step is to identify how much you're gonna lose on that trade. For that to identify, the best method is to keep the strict stop loss to the particular patterns based on the behavior. I'll be discussing the case studies which I captured on the month of January 2017. Okay, let's go ahead. 2017 trade reviews. In January, as per my patterns, the best trading was 6 days in January. Means in January, out of 20 days of trading, I had only 6 perfect pattern repeatable days, which best achievable points was 50 points. The best days were 4 consecutive Dooji days. I'll be discussing more about the technical terms in my blog at tradepsychology.com. If you want more details, go visit my site. Thank you. Here we're gonna see how the Nifty reacted on this day, on 11th of January 2017. It was a bullish day. The learnings was it was a trending day. I waited for some pullback in the Nifty's trend, and the entire day it never pulled back below the stochastics of 20. But at the afternoon session, we saw a strong pullback and breakout of the resistance, which is the uppermost resistance, and pulled the Nifties to the peak. Well, this pattern can be identified by a multi-day resistance breakout pattern. Here we can see this. We had a resistance at 9321, which was broken on that day, and Nifty rallied almost 100 points. Well, the one pattern of identifying the stop loss is, if you are buying at the afternoon session, if you identify the breakout, keep a stop loss of 2 points, and then keep the target of 10 points based on the Nifty's movement. Well, I'll be discussing more in detail in the next slide. This was on 16th of January, we had a Dooji day. A Dooji is a candlestick pattern form where the movement is from top to bottom, means the day has moved from positive to negative side and ended up in a positive side. This Dooji of showing green candle identifies the Nifty has moved to the negative side and closed on the positive side. Well, here you can see the Nifty opened up gap down, but as soon as 10 a.m. in the morning, it pulled back almost a 40% of its premium. Well, this pattern can be predicted by using a Dooji day. The Dooji day, we have an advantage that the Nifty is moving in the higher range. This pattern is called as an upper flag pattern. Here you can see the Nifty has pulled back, and we are seeing a small consolidation. Well, at the afternoon, we saw a flag breakout at the 30 premium, and it spiked almost 2 points. This is a very predictable pattern for as a flag pattern, and we could have easily made 2 points. This is one of the patterns which is very repetitive in the Nifty's premium. For this trade, if you are entering at the 30, the stop loss would be 2 points, that is 28. This line is merely a stop loss. For this, if you have hit the 2 points, hence we had a risk to reward ratio of 1:1, which is 30 and 32, and stop loss was 28. Similarly, on the next day of the doji, we had a same repeatable pattern. Here also, we saw a choppy day, but we had a multi-day resistance breakout. Similarly, as of earlier cases, here also, if we had predicted this breakout at 29, we had a 2 points rally with a stop loss of 2 points. This is also a flag pattern which resembles the same, as we have a consolidation, but when it broke out at this highs, which was the entering point at 29, we had a 2-point profit. And the third consecutive day, we had a doji day. Here, the first predictable pattern, as it was a doji day, we had a fall in the morning and we had a pullback at this level and hit the first support line. Here we can see we are seeing a small flag pattern, and afternoon we saw a rally. Here also, if we had entered at the premium of 33, we had a 2 points of profit with a stop loss of 2 points, 1:1 ratio. By this conversation which I am making, we can make a note that on the doji days we get the flag pattern, but the most important thing is you can see the flag pattern is formed at exactly after the 12 p.m. which identifies that in the afternoon opening of the European markets, we can see a doji pattern and we can enter right at the top of this flag pattern. And similarly, we have to keep the strict profit point and also the stop loss if the pattern fails. And one should make sure that the flag pattern gives a profit risk reward of 1:1. Next, coming to the final doji day, it was a pullback, but we saw a strong pullback from 30s to 44 levels. Similarly, here in this pattern, we could not see the flag pattern. But in the earlier cases, if we had identified the trend with a flag pattern, we can enter right at the top of the first flag, which gives almost 2 points potential profit, which is very predictable, and it has worked almost 90 to 95% of the times. This is how you can identify the trend, the pattern, and also the stop loss for that particular trade. Winding up my session, today's topic was identifying the stop loss. I explained how you can identify the stop loss. The one best method will be using the moving average, or using the VWAP indicator, or using the support and pivot lines. These are the 3 main key parameters which you can use to keep the stop loss. Well, in the further videos, I'll be showing you the real trades which I took on identifying the target levels, and also how to predict the repeatable patterns which gives the consistent profits. This video was mainly to showcase how small stop loss can help you grow consistently, as not one single trade can make you a big money, but these are the repetitive trades which are in positive notes, which gives you a consistent profit. Thank you.